All right, what's up, everyone? This is Kirk here again at Option Alpha. So, thanks so much for joining me today. We've got, I think, what should be pretty much a two-part series. We may go into a three-part series, just depending on how many questions we get on this. But I did a video on this topic a little while ago, and it was actually a really popular one. And so, what I wanted to do is kind of recycle this again because I think it's an important topic and hopefully it can add a lot of value for you if you're starting out trading options. So, the topic that we're going to be jumping into today is how I would start trading with $3,000. Now, I will say right off the bat, I don't suggest that you start with $3,000. So I say right in here, like, first, let it be known, I do not suggest that you start with $3,000. I think you start with something closer to $5,000 if you can. I mean, that honestly is the more ideal scenario, is to start with something around 5K. But if you twisted my arm and you said, Kirk, you have to absolutely start with $3,000, how would you possibly do it? So this is my assumption on how you would do it. The interesting thing about this, that if you follow along with this series, you'll see is that I've already done this in my Option Alpha account, and I'm already trading a bot that does all of the things that we're going to talk about here and have been for a couple years now. And so we'll go through the results of that. You can see the highs, the lows, where it's all at. So I'm kind of not only just telling you what I think you should do, what I do, like my kind of concept around this. You can do whatever you want. I'm not telling you what to do, but like my kind of concept on how I would structure this. But I'm also kind of eating my own dog food in a sense, where I'm actually doing what I think we should do here in an automated fashion using Option Alpha. So either way, you can do it manually, you can do it automated. This hopefully gives you a blueprint, kind of a layout of how to do it. And then you can build from here. Okay. So like I said, first, let it be known, of course, I don't suggest you start with $3,000. It's not because I don't think 5,000 is just a higher amount and better than 3,000. It's because actually the math works better at 5,000, and we'll kind of get into it. So it's just purely a math thing. So you obviously have to start with some capital. I just picked $3,000 because one person a couple of years ago was like, well, I don't even have 5,000. So how could I start with 3,000? Okay. But again, let's assume you're forcing my hand, you're twisting my arm. You say, we have to start trading with $3,000. What would I do? How would I set up the portfolios? What tickers would I trade? What strategies would I use? And again, like I said, we're going to review a live bot that's been running this strategy for nearly 3 years now. All right. So first thing that we actually have to start with is we have to start with a talk about this like risk profile, or kind of like this risk curve that you want to be on. And just, it's not necessarily that you have to like know exactly where you're at, but it probably helps to know what it kind of looks like as you go out this risk curve and this risk profile. So if you look at this, and I built this a while ago for a boot camp that we did. And so on the bottom is risk, where the left side is lower risk and the far right side is higher risk. And then on the far left and kind of the vertical axis, you have your potential return. So there's these different profiles that you can, or portfolios that you can build that kind of move you along this risk and return, kind of matrix, if you want to call it that, right? So on the bottom left-hand corner, you've got obviously the most conservative portfolio. And this conservative portfolio is mostly made up with a lot of cash. So what you'll see in those is that this green amount right here, that green is kind of like a representation of a pie chart of a portfolio, where that green amount is the cash that's sitting in that account. And the other slices of the pie chart are positions. So if you look here, you can see that the most conservative portfolio will probably have the most cash, right? Or cash equivalents, cash-like things. This makes a lot of sense. This is normal portfolio investing 101. And as you go out the risk curve and you start to try to gain more potential return, you start to risk more capital in the hopes of gaining more potential return, you start moving vertically and out to the right on this risk return curve or matrix, okay? There comes a point at which, though, you start moving to a level that creates a significant amount of diminishing returns, in the sense that you're taking on more and more and more risk, and each unit of risk that you take on is equally met with less and less potential benefit and return. So I don't know where that is for you, but there's a point at which you take on so much risk. And if I like extended this curve out, that you would take on so much risk that actually the curve starts to bend back the other direction, right? Think like no cash, leverage on leverage, extreme leverage, omnidirectional trading, right? Like there's things that would actually bend the curve back to the other direction, and you have no returns or negative returns with insane amount of risk. So there's this idea first that we have to get to, which is that we have to try to figure out where we are on this risk curve, right? You could be conservative. That's where I live. Should be no surprise. For many years, I'm super conservative with my trading. So that doesn't mean I'm perfect. I'm just saying I'm conservative. A lot of people are not conservative. Maybe you are. You could be more moderate, so less than 50%. Maybe you're at 30, 40% cash. You could be in the growth phase where you're kind of 25, 30% cash. You could start edging towards the gambling phase, which would be, 20, 25% cash with a lot more positions. And then you get, 20% cash, whatever. Then you get towards the insanity, which is that you have a small account and you just no cash, no backup, no, plan B. It's just make it or break it, to the moon or crash, right? I don't think you should probably be in those zones. It's not my personal opinion, or, I'm not telling you what to do. This is my personal opinion. I don't think you should be in those zones. I think if you're trading with a small account, you've got a little bit of cash that you're kind of working with and you're starting to work it up, I would say you should be more in the conservative to moderate camp, if you will. Okay. And then of course, these little slices, like I said, these are positions. So these things right here are going to be your positions. Just as you grow out this curve, your position sizes will start to get slightly larger or start to fit actually what they should be. And you might allow yourself to add more tickers or more positions to your portfolio. Okay. But that would only be as you start to really grow your capital account balance. Okay. So let's just look at the blueprint for a second here. So this is important to start with. So as we start thinking about how would I build a $3,000 portfolio, there's a couple key elements I need to have. And so in part one of the series here, we'll probably go through the first 2 to 3 of these. And then in the second part, we'll go through part 4, 5, 6, etc. Okay, and kind of continue on that path. So the first thing you got to have is you got to have ample cash and small position sizes. This is a really key one. It's mostly missed by 99% of traders, I would say. I've seen an ungodly amount of people who have at some point emailed in, messaged in, written in, posted about blowing up their account, coming close, losing money, whatever. If you really dig into it, most of it ends up being position sizing and not enough cash. I mean, it's golden rule number one. It's the one that's easiest to break, but it's the one that you can't break. It's the one you have to stay vigilant in making sure you have, because it's so important. So golden rule number one, first thing that we need is ample cash, small position sizes, ideally 5% risk per ticker symbol that you're trading, which we'll get into more today. Number two is market neutral, high probability trades. Typically, these will be iron condors with 70% pop, which is probability of profit. Reason that we want these is we don't want to take market direction. We don't want to be bullish. We don't want to be bearish. We just want to be market neutral within a range. And we want to enter positions that have high probability of success so that we're not just playing the coin flip game where we're winning, losing, and we get into a really bad string of losers that could take out the account. So ideally, we try to do things as protective as we possibly can. We can't do it zero risk, but we can do it with higher probability trades. And then the third thing is we've got to filter for trades that have positive expected value and some minimum volatility requirements. So it's got to be trades that have good volatility where IVR is over 20. That's your implied volatility rank. And you've got to have expected values of at least $5 or more. And again, we'll kind of talk through why this is so important here today as we continue forward. Okay. So the first discussion that we have to have on is ample cash. Okay. So let me actually go back up here and I look at this chart here, and I'm going to be building out, or what I already built out, what I'm going to be displaying today is a conservative portfolio. So I'm super conservative. You can obviously adjust these numbers if you want. That's your prerogative, but I'm going to be going for a very conservative approach. And the conservative approach that I start with is 50% of the account in cash. So we'll get to that as we start to get, further into the parts in the series. But just to let you guys know, it's going to be 50% of the account in cash. That means that if you've got $3,000, $1,500 sits in cash the entire time. You don't do anything with it. You don't trade it. You don't put it into anything. If you earn a little bit of money market interest with it, fine, whatever. But it needs to be there as a backup. It needs to be cash in the account. You got to have cash in the account. It's so, so important because it has to be a backstop. In case everything else blows up, you still have cash that you can keep the lights on and start all over again. Now, we're going to construct the portfolio numbers-wise, like math-wise, so that we give ourselves the best chance of success possible. But if the worst case scenario happens, we need to have some ample cash backup that can keep the lights on. So we have to have at least $1,500 of cash in the account. Okay. So now what do we do with the other $1,500? Well, I said we split it among positions that ideally have 5% of risk per ticker symbol or less. What do I mean by this and why does it matter? Number one, it means that 5% risk is per symbol that you're trading. So if you're trading SPY, all positions that you have in SPY can be no more than 5% risk in your account. That's the goal. That's the target. And with a $3,000 account, it is hard to get there. It's not impossible, but it is hard to get there. That's why a $5,000 account works a little bit better math-wise because you can get that position size into that 5% range. $3,000 account might be a little bit tougher, but you got to get to something close to less than 5%. Under 5%, even better, right? But above 5%, it becomes really risky. The reason that it becomes risky is because of this chart right here. Now, I know some people are like, yeah, math charts, blah, blah, blah. But this chart is really important because this, I think, is the secret killer of a lot of traders. I think that sequence of return risk is a secret killer of traders because what happens is that when you start trading and when your position size is too large, you basically open yourself up to the risk that a few consecutive losses in a row blow you up, okay? A few consecutive losses in a row blow you up. So what do I mean by this? I mean that let's say you make a trade and let's say you don't follow what I'm saying at all. You make a trade and you risk 50% of your account on one single trade. That's it. One trade, half of your account. So you got $3,000. You put a trade in. It's $1,500. You're like, screw this, Kirk. I'm not even listening to you. I'm going to put $1,500 position in. One trade. That trade ends up being a 50-50 trade, right? 50% chance of success. It could go either way. Either you're going to make money or you're going to lose money, but it's a 50-50 bet. It's not even a high probability bet. You're still not even convinced, right? If you do that, the likelihood that you have one consecutive loss is 1 in 2, right? That makes a lot of sense because it's a 50-50 bet. So 1 out of every 2, trades that you make are going to be losers, that you have one consecutive loss. So you lose on that first trade. That stinks. Now your account is cut in half. I'm just playing out like a mental experiment here, right? So your account is now cut in half. You've got your $3,000 balance got cut to $1,500. So now you say, all right, let's just go all in. Let's open up the gates, right? We'll do $1,500 because I know this stock is going to go down or up or whatever you tell yourself. And so now you bet the other $1,500. So if you get to this point, 2 consecutive losses would knock you out, right? 2 consecutive losses. And you start thinking to yourself, well, I lost on that first trade. There's no way I'm going to lose on the next trade, right? But if you get to 2 consecutive losses, the odds of that happening is 1 in 4. You could get lucky and you could win and you're back to even, right? You're back to par. But what if you don't? What if you hit 2 very bad trades in a row with 2 very large position sizes, and now you've completely blown up your account in 2 trades? And so what this table shows you is the math, just the pure math of consecutive losses at different probabilities of success. So if you were to trade at the 50% probability of success level, and you had 2 consecutive losses in a row, you've got a 1 in 4 chance of blowing up your account just like that. That has nothing to do with the strategy you traded, the ticker, whatever. It's purely based on the probabilities and the position size. So if you're trading too large, right, then your probability of reaching that point is, or the likelihood that you blow up your account is very, very high. Now, if you just traded at the 50% probability of success level, so you're still not even at the around 70%, which is where I think you should be for a small account, but let's say you stuck to the 50% level, but you cut your position sizing down to 5%. That means you'd have to lose 20 consecutive trades in a row at 5%, right? Because 5 trades times 20, or 5% times 20 consecutive trades is 100% of your account. You'd have to lose 20 consecutive trades in a row to blow up your account just by reducing your position sizing. And the odds of that happening is 1 in 10.4 million. So you could still be a half, like 50-50 trader and still survive purely based on position sizing. Because what you don't want to do is you don't want to play anywhere in this ballpark. Like anywhere in the 1 to 5 consecutive losses in a row, that's not a good place to play. Because then you just are asking for trouble. Like there's a saying, right? You could like run through a dynamite factory with a match, and you could get out the other end, but it doesn't mean it's a good idea to keep running through the factory with a match, right? Like you're literally playing with fire here. You're skating on thin ice, whatever analogy you want to use. So what I say is okay, you need to have position sizes at 5% or less if you can help it. Again, a $3,000 account is going to be really hard to do it. We might have to stretch that a little bit just because it's a smaller account. But if we do go down that low in position sizes, that means that it would take probably 20 consecutive losing trades in a row to blow up our account, right? And at 20 consecutive losing trades in a row, at a 70% probability of success, we're looking at the odds that we completely blow up our account as about 1 in 28 billion. So just based on math, not doing anything else, not adding any other risk metrics in, not doing any sorts of potential later adjustments or filtering for criteria, right? Just based on numbers for position sizing, right, for our account, it's very, very hard mathematically to completely blow up your account trading 70% probability of success positions with a small position size, okay? Very hard to do. So if you think about equity risk per trade symbol or ticker, okay? So again, this is per symbol. If you've got $5,000, then 5% per symbol would be $250. So that's your max. And look, I'm telling you, like, this is easy for people to break. The people break this all the time. They go, well, I've got $10,000. I don't know, like $1,000 seems like a good position size. No, $1,000 when you've got a $10,000 account is double the position size that you should possibly have. So you have to cut your position size in half. I don't care how good of a trade it is. I don't care how awesome it looks. I don't care how cool the technical setup is. It doesn't matter. You have to cut your position size in half. You've got to stay 5% or under. So that means if you see a sweet, sweet trade for $1,000, you better have a $20,000 account to even think about getting into that position, right? To even consider it. Vigilant about our position sizing. Again, and this is all still keeping $1,500 in cash, okay? Options are a leverage product. You don't need to trade everything to do it well with options. You can do it with a leverage product as long as you take care of the risk sizing with positions, okay? All right, so the next thing, let me go back up to our list, right? Here's our list. So we kind of talked about ample cash, small position sizing. I feel like I beat a dead horse over this over 10 years, but it's still not the case that everyone follows it. So I will continue to beat this dead horse until it's fully dead. Number 2, market neutral, high probability trades. These are iron condors with 70% probabilities of success or greater. So this is what we're going to be trading in this strategy, this portfolio, whatever you want to call it. We're going to be trading iron condors. Why do we want to trade iron condors? Because they are market neutral. And basically what you're trying to do is you're trying to sell options, which is the better side of the trade to be on. And you're trying to do it in a market neutral, market direction neutral way. So what you don't want to do is you don't want to take these crazy bets on the market with a small account. So small account, you don't want to take bets on the market. You don't want to go, I think it's going up, I think it's going down. That's never worked for me. It's never worked for anybody, right? Consistently, like it just doesn't work. With a small account, you want to do market neutral. Like I don't care, market agnostic, directional agnostic. You don't care where the market goes. When you get a bigger account, you can take some of those smaller bets if you want to. I'm bearish on gold. I'm bullish on oil. I'm blah, blah, blah. Do those in small position sizes. But with a small account, you don't have that luxury. Okay. You have to be very consistent, very systematic about it. With an iron condor, what we're doing is we're selling two different credit spreads essentially. So we've got a put credit spread on this side, on the lower side, where we're selling, say, the 95 strike put and buying the 90 strike put. And then we're adding a call credit spread and combining these together. And that's what creates this kind of weird, funky pyramid rhombus looking payoff diagram. Where on the call side, we're selling a 105 call and then buying a 110 call a little bit further up. And so what you get is you get this range where as long as the market stays inside this range between your break evens, in this case 93 and 107, you make money on the trade. And why I like these is because I don't have to choose which direction the market's going in. I just give the market a big net or range to fall into. And as long as it stays somewhere in that range, I make money at expiration. Now, if it goes outside of that range, that's where you could lose on this trade, right? But we're giving it a bigger range that hopefully gives us that higher probability of success, that 70% probability of success range. Now, what I do is I kind of think about it visually like this. So I'm just taking this graph here and I'm just turning it visually because this is what you actually see in the market, okay? We don't see graphs like this. I don't know who originally created this, but this is what everyone uses. This is what everyone learns on. It's kind of weird. So I kind of turn it like this and I say, okay, this is the same payoff diagram, same model, but now what it's doing is it's looking at it visually, vertically like this on kind of like a stock chart, like how you would look at it. So if the market's kind of trading like this, right here, right, market's kind of neutral, you would sell the 105, buy the 110 call, right? So you sell this call option a little bit closer, buy the call option a little bit further out, sell the 95 put and buy the 90 strike put a little bit further out. And so that creates these different ranges where as long as the market stays in this range, this is your range where all the contracts expire, OTM are out of the money, and you get max profit. Whatever premium you took in to sell the position, you keep. You sell it for $100, you keep $100, and onward you go. If the market goes outside of this range, and this is what we're doing, we're forcing the market to do something that it doesn't normally do, right? Or most of the time doesn't consecutively do this, where it trades really far outside of this range. But if it does have a huge rally or huge drop, right, then we get into our max loss territory. So this is the risk. The risk is the market has really, really big moves outside of this range that we've created. And if that happens, then we find ourselves in a position where we lose on that trade. So if we just continue moving forward, we enter the trade, like let's say we enter the trade here, the market goes up, it could briefly start to touch our break evens and then it could come back down, right? It honestly doesn't matter. As long as the stock, market, ticker, whatever you're trading lands in between these zones at expiration, that's when you make money on the position, okay? And so we want to trade those because those are very, very market neutral. You don't have to pick a direction. They're easy to trade, right? It just makes life a lot simpler for a small account. All right. The next thing that we need to talk about is expected value. So we've already kind of talked about iron condors and just generally why we're going to trade them. Now let's talk about this whole thing about expected value. So let me go back up, right? And what I had said here is that we need to filter for trades with a positive expected value and some minimum volatility. Minimum volatility is like a little filter that we can do. We just don't want to be selling in front of a huge volatility spike if we can help it, right? So we got to do some minimum kind of low level volatility filtering. But the key here is we got to get into positions with a positive expected value. So what does that mean? That means that what we have to do is we've got to look for trades that make sense numbers wise when we win and when we lose. And the best way I can describe this is with an example of a coin flip. And then that will help you with some other examples I'll show you. Okay. So let's assume that we're going to play a game, just a game between me and you, and we're going to flip a coin. That's it. Just a regular coin, right? We're going to flip it. And if it lands on heads, you win. And just in this first game, this first example, regular coin, if it lands on heads, you win $100. If it lands on tails, I win $100, so you lose. And we're going to say, because we know mathematically that the probability of this coin landing on heads or tails is 50% each. So if you take those numbers and you take the amount of money that you could win times the probability of winning that money, and the amount of money you could lose times the probability of losing that money, and you calculate that out, you can actually get to an expected value. Like, what is the expected outcome of this game for you? The expected outcome of this game should be pretty evident. It's 0, right? Because half of the time I'm going to win $100, half of the time I'm going to lose $100. At the end of the day, my expected outcome is 0. I'm not really making money or losing money. I'm not making money. I'm not losing money. I'm just trading $100 back and forth and flipping a coin. Okay. So if you think about that, let's now take the game one step further. Okay. Let's change the payout here so that it's more favorable for you. So now we do the same coin. You know this coin's going to flip 50 heads, 50 tails. But now let's change the payout. And all I'm going to do is I'm going to change the payout by increasing the payout when you win. So when you win, I'm going to pay you $150. And when you lose, you're going to pay me $100. Now, this is a game you should play all day, every day, all night in your sleep as many times as you possibly can. By the way, I'm not really going to play this game with you because I know the odds of this one and I'm not going to pay out. Okay. But if someone came to you and said that they want to play this game, you should play this game because the expected value of this game, the expected payout of this game is actually $25. 150 times 50 plus 100 times the 50% for losers, and then you get $25. Okay. So if somebody comes to you and says, let's play a coin flip game, you win, you get 150, you lose, you pay 100, play that game all day. Okay. Let's change up the numbers now. Now let's start to change the game. And by changing up the game now, instead of using a regular coin, I'm going to physically go and bend this coin. I'm going to bend this coin so it lands on heads a slightly lower number of times. So when I flip the coin, it's now a bent coin. It's a bent coin in my favor, in the favor of tails, right? And so now this coin has, let's call it a 45% chance of landing on heads and about a 55% chance of landing on tails. Now, even with this bent coin, which seems like, oh, that's kind of unfair, the payout of that game is still so high when you win $150 that it makes the expected value of the game still positive, right? You want to find games like this where even if the coin's bent, even though it's not a 50-50 trade, the winning dollar amount when you win is more than enough to cover the higher losers that you have, and you're still left with about $12.50 on average for each flip, okay? Now let's play it even more out. So let's take this whole thing even further out. And let's say I keep bending the coin. So I'm like, I'm not satisfied with that, so I go and bend the coin again, but I keep the payout at $150. And so what you'll see here is that if I bend the coin in game 3, now my probability of winning is 30%. So I'm making $150, but I'm only making $150 30% of the time. And 70% of the time, I'm losing $100. Then that means that the expected value of that game is negative $25, which means if you keep playing that game, even though it might feel like you're winning more money, because you are winning more money when you win, the net result of that game is that you lose money. If you go to number 4, where I completely bend the coin all the way so there's no chance that it lands on heads, it's always going to land on tails. Of course, the expected outcome of that game is $100. You're just going to pay me $100 every time it flips because there's zero chance that it lands on heads because it's completely bent. It can't even land on heads, which means you're never going to get your $150, okay? Let's say I change the values. Look, I'm just changing the values of this game to make it potentially more fair. Let's say, okay, fine. Game number 3 with this really bent coin, it's not all the way bent. You still win 30% of the time. That one, you are going to win $200. Well, it still doesn't change the math. It's still a negative expected value game, right? So it doesn't matter. Let's say in the 4th game, I say, look, if you win, if it does land on heads, I don't know, maybe there's a chance it balances perfectly on there. I'm going to pay you $1,000, but there's no chance it's going to happen. So it doesn't matter how big I make this number. The expected outcome of this game is still negative $100. Okay. So that is the key with trading, is that even though you're going to make these high probability trades, these high probability iron condor trades, you have to make sure that you're finding trades that have positive expected value. And it's actually relatively easy to calculate the positive expected value because we just have to calculate the probability of getting to max loss, the probability of max profit, and all of these partial profits, partial losses inside of an iron condor. Now, you could do this by hand. It would take a long time and some math and probably a calculator and a spreadsheet, and then the market pricing would move, or you could just use Option Alpha. We do this automatically for you, and we pay for the processing power and servers to do this calculation for you. So that when you go into a trading strategy and you start looking at a trade, you can see immediately what not only your break evens are and your max profit and your max loss of a position like this one I built out for this example, but you can also see all of the other probabilities and expected value. So let's take this one as an example before we wrap up. So this one here is max profit is $49. The max loss is $51. This is a very small trade, very manageable trade for a small account, especially a $3,000 portfolio, right? Anybody can make this trade with 50 bucks. This trade right here has a probability of max profit of 54% and a probability of max loss of 34%. Based on all the history and the option pricing for this thing, we can calculate those, right? And then we can use those to figure out what our expected value is going to be for this trade. It's no different than the coin flip, right? We're just doing all those calculations on the fly for you so that you know this strategy right here, if you were to trade it over and over and over again, has a positive expected value. Now, does this mean it's going to win? No, there's still a 54% chance that you get max loss, a 34% chance that you, or 54% chance you get max profit, 34% chance of max loss. It's still not a guaranteed winner for this trade. But what I'm saying is if you make this trade over and over and over and over again, you're much more likely to find yourself making money with this trade because the math just works better. Now, if I give you an example of one that doesn't work, because you can build out whatever you want inside of Option Alpha and we show you all this math, this would be an example of one that does not work. And this one here has an expected value of negative $40. It makes a lot of sense because if you just look at it, compare it, like just remember the coin flip that we just went through. Your max profit is $73. And the probability of reaching max profit is 73%. Hey, you got a high probability trade. Now, most traders on the outside, they would look at this and say, that's a high probability trade, I'm going to make it. But that's not the whole point. We need high probability trades that also have high expected values, right? And positive expected values. This trade has a 60% probability of profit. I would take it over the other trade any day because it has a positive expected value. This trade has a 74% chance of profit, still a high probability trade, but the math doesn't work here because when I win, and I'll win 73%, 74% of the time, right? I'll win $73. But when I lose big time. And I lose more often and a higher amount than is ever able to be compensated by the amount that I win. And that's what gets me to a negative expected value for this trade. You should not make this trade. That doesn't mean that people aren't trading it. People are trading it. It doesn't mean that you should trade it. It means you should filter for things like this so that you're getting into the absolute best possible trade from the start that has the best criteria from the start. It's no different than the coin flip, right? What game do you want to play? You want to play these two games. You don't want to play the games 3 and 4. The games 3 and 4 are for other people. You want to play games 1 and 2 because these games have positive expected value. That's what you need to look for in your trading is make sure you've got positive expected value, not negative expected value. Okay. All right. So listen, that wraps it up for this week for part 1. So next week, when we come back, or maybe not next week, maybe 2 weeks or whatever the month is, whatever the sequence is that we're on this, we're going to come back and we're going to do part 2 where we're going to finish out here. We're going to talk about ticker symbols. We're going to start looking at the actual strategy and bot that I'm actually running and how we kind of bring all of this together. But I hope this was a really good primer for you, why you need small position sizes, ample cash, why you've got to trade neutral positions, and you got to have positive expected value. So I will see you again on the next episode. Until then, happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.